On the EA exam, trusts show up in two very different ways: legitimate planning and abusive schemes dressed up as tax magic. The big clue is simple: someone must pay tax on the income. If the pitch says no one pays or your personal bills become deductions, you should immediately think substance over form and ownership rules. Promoters love a menu of promises. They'll claim the trust can deduct your groceries, your kids' tuition, or your vacation as trust expenses. They may claim depreciation on your personal residence, a stepped-up basis just for transferring property in, or that self-employment tax disappears. They'll even claim gift and estate taxes vanish. On the exam, treat these as red flags, not planning tools. Here's why these schemes fail. Tax law looks at substance, not labels. If you still control the assets, enjoy the benefits, and the trust just pays your lifestyle, the IRS can treat you as the true owner. And personal expenses are generally non-deductible, even if you route the payment through a trust checking account. The trust form doesn't change the character of the expense. A classic abusive pattern is multiple trusts holding different pieces of your life. One for the house, one for the business, one for the car, sometimes with a fake charity tossed in. If the trust rents your home back to you and you try to deduct landscaping, utilities, or pool service, that's exactly the kind of fact pattern they test. Promoters and participants can face civil penalties and even criminal exposure. Don't overcorrect though. A trust can legitimately pay for someone's needs, like planning for a disabled family member. The key is that income is still taxable, often to the beneficiary, and the arrangement has a real non-tax purpose. On the EA exam, the trap is thinking trust equals tax-free. Even special trusts don't make income disappear, they just change who reports it. Now, foreign trust basics. A trust is foreign unless it passes both parts of the court and control test. First, a U.S. court must be able to supervise the trust. Second, U.S. persons must control all substantial decisions. Miss either one, and it's a foreign trust. The IRS scrutinizes these because secrecy jurisdictions and tax haven marketing often go hand in hand with non-compliance. The reporting landmine is FBAR. If a U.S. taxpayer has an interest in, or signatory or other authority over, foreign trust accounts, they may need FinCEN Form 114. The trigger is the aggregate value of foreign accounts exceeding $10,000 at any time during the year. On the EA exam, they love that phrase, at any time. One day, over $10,000 counts. The executor of a decedent's estate chooses the estate's accounting period based on which rule. The options include: it must be a fiscal year based on date of death. The executor chooses when filing the first return. It must be a calendar year unless IRS approves, or it's based on the decedent's birth date. Think about it. When does the executor actually lock in the tax year? The correct answer is, when filing its first return, the executor can choose the calendar year or a fiscal year. An estate is allowed to adopt either, and the choice is made on the first Form 1041. A tempting wrong choice is the date of death forces a fiscal year idea. Date of death starts the estate, but it doesn't force the year end. Daniel Whitaker died in 2023, and the executor elected a fiscal year end of October 31st for the estate. What is the deadline to file Form 1041 with no extension? The choices include April 15th, February 15th, January 15th, and March 15th. Think it through. Form 1041 is due a certain month count after year end. The correct answer is February 15th. Form 1041 is due the 15th day of the fourth month after the end of the tax year. If the year ends October 31st, month 1 is November, then December, January, and the fourth month is February, so February 15th. March 15th is tempting if you miscount months from October.